Hey guys, welcome back to the channel. So today we're going to be talking about inflation, how to hedge against inflation, like things you can do. But mostly I really want to talk about just like what is inflation and how to, how people combat it and what people say about it. Give a little background into it, right? Because the year over year US inflation rate came in at like around 5%. I think it's a little under 5%, right? And that's the fastest pace of higher prices since 2008, right? So we need to give some context around this number, right? So about a year ago, the economy was still kind of, waking up from its, the pandemic slumber, right? Well, things like used cars and airfares make up a decent amount of this jump in prices. Inflation readings will likely be lower, the coming months because of this. The bond market still doesn't seem to care, and this bout of inflation is probably transitory. Well, we'll see about that, right? But there are certain goods and services that are seeing price increases that will be permanent, right? Inflation is much more personal than any government statistic. Some households will experience more pain than others, depending on, like where you spend your money, how you spend your money, stuff like that. Regardless of what happens to price levels from here, inflation is going to be an ever present risk for any investor. So, beyond keeping your lifestyle inflation under control and increasing your pay, the best way to hedge against rising prices is to stay invested in the stock market, right? That's not the sexy inflation hedge most people are looking for, but it's probably the easiest answer, right? And it's not just important to stay invested while inflation is here, right? So you've heard, dollar cost averaging, right? Like that's like one of the big things. Okay, you just want to stay invested, right? If the stock market dips, don't sell, don't panic sell, just keep dollar cost averaging in, right? As it's going down, dollar cost averaging. As it's going up, dollar cost averaging. Just keep doing it, and you really shouldn't have a problem, right? Deflation in the 1930s was followed by an inflationary spike in the 1940s that led to terrible returns, right? That was followed by a huge boom, mainly in the 1950s, that gave investors, just amazing, incredible returns for almost, 20 years, maybe a little bit more than 20 years, right? Inflation spiked in the 1970s, leaving investors with decent nominal returns but awful real returns. Investors in the US stock market lost more than, I think it's like 30 to 35% after adjusting for inflation from 1966 to 1981, right? The 1980s and 1990s still saw some inflation, but it was falling, and that led to some amazing returns for investors, right? The 2000 to 2008 timeframe was bookended by two gargantuan crashes of more than 50%. When you take into account the 3% inflation, investors lost close to 7% per year for 9 years, right? The most recent cycle has been the best of both worlds: high nominal returns and low inflation. Now, you could make the claim that periods like the 1966 to 1981 show why the stock market isn't always your best bet, right? When inflation ran the hottest over a long stretch, the stock market failed to keep up. But it's because of periods like this that you really need to stay invested, right? You can see that, the nominal returns are only 6% in the 66 to 81 bracket, and the inflation was 6.8%. So, you end up losing about 0.8, 0.9% on your real returns. This is really not what you're looking for, right? And of course, the same thing happened in 2008, the 2000 to 2008. And of course, everyone knows about in 2008, the big financial crisis that hit the US, right? So, while yes, returns from 1966 to 1981 were negative on a real basis, right? But let's combine that inflationary bust with the booms that preceded and followed it. From 1943 to 1981, nominal annual returns were about 11.5%, with a 4.5% annual inflation rate. So that's going to mean real returns were roughly 7% per year in this, almost 40-year time period, all right? So from 1966 to 1999, nominal annual returns were 12.3% against a 5% annual inflation rate, leaving investors with 7.3% real returns over 34 years. The same applies when we combine other down cycles with up cycles. So from 1982 to 2008, real returns were 7.3% per year. The boom of the 80s and 90s smoothed out the big bust from the 2000 to 2008. Even looking at 2000 to 2020, right? It has it's given investors around 5% a year in real returns. Not bad considering we've now lived through 3 recessions and 3 massive stock market crashes this century. So really the point here is the best way to prepare for terrible periods in the stock market is by staying invested over the long haul. Right? The best way to offset periods of low real returns is by being invested during periods of high real returns. Right? This is where, you've heard probably really big quotes, or I won't say really big quotes, but you've heard quotes from really, big individuals out there, right? Saying, buy the dip and, don't sell the dip and stuff like that. That's really what you're looking for. That's why a lot of people say the easiest way, like I said earlier, is the dollar cost average. It really is going to make everything easier. Just dollar cost average down, dollar cost average up. It'll all smooth out. And really, you don't have to even pick, if you want to make it even easier, right? You don't even need to pick individual stocks. You can dollar cost average into an index fund, right? Just get it out of the way, super easy, no problems, right? The previous 12 years, though, gave investors higher than average returns in an environment of lower than average inflation. If going forward we now experience lower than average returns with higher than average inflation, or even really, even average inflation, being invested since 2009 was your hedge against it. And I'm not really sure. I don't really know if higher inflation is here to stay or not. And there are to be fair, there's a lot of compelling arguments on both sides, right? I can see either one, right? But regardless of the reason, the stock market's going to be underwhelming at some point going forward. Many investors are going to assume that means getting out of the market. But again, I don't think you should do that. I really think the easiest way is for you to dollar cost average into an index fund and call it a day, right? But there's only one guaranteed way to lose money to inflation. And that's if you don't invest at all, right? So don't let your money sit in a savings account because it just loses its value to inflation. Just automatically set it up to dollar cost average yourself in every week or every payday, every other week, however you want to do it. Just automatic, get it done, do it, right? So I really hope this guys, helped you guys a little bit, maybe give you some information. I mean, honestly, just find you an index fund, dollar cost on your way up, dollar cost on your way down, and you really don't need to worry about inflation that much. I hope you guys enjoyed it. If you did, go ahead and give the video a like, subscribe if you're not already subscribed, and so I'll see you guys in the next video. Y'all be safe.